Is McDonald's stock a buy near its 52-week low? It's been crazy for McDonald's shareholders. The stock is down 14.6% on the year, and this doesn't happen very often, I can say. If you look at the stock, it has been mostly positive in 2022. It only declined 1.6% in a stock market crash. 2014, it closed down 3% on the year. 2012, it closed down 12%. But most of the time, McDonald's has been positive, or maybe down 12% on the most since 2003. And now it's down around 14.6%. It doesn't happen very often. The question is McDonald's an amazing buying opportunity at this price, or is it maybe still overvalued and we should wait for a lower price? This is what I'm going to discuss here in this video. Now, the last earnings report, it wasn't the best, I have to say. Earnings per share, 270 versus 272. They did miss on earnings per share, which again doesn't happen very often. But this is what happened with McDonald's. The stock market freaked out. The stock started going down. It went down like 3% on earnings. On revenue, they did a slight beat on revenue, but they did miss on earnings per share. And this is what the market pays attention to. They've been suffering a lot in terms of same-store sales growth, especially outside the United States. But I believe in total, the growth was like 2%, which is nothing for a company like McDonald's. They're trying to re-establish the $5 meal. Because, I mean, it's not just McDonald's, Starbucks is suffering also, Dunkin' Donuts is suffering also. A lot of retailers and just the United States, things are slowing down in general. And I'm not surprised. I mean, student loans have resumed. We have 5.5% interest rates. Things don't last forever. And things have been slowing down. And even at McDonald's, things have been pulling back. A lot of people believe McDonald's got a little bit overpriced, especially in regions like California and many others. So they're trying to reestablish the $5 meal. But this is only going to be on a limited time. So it's not going to be here forever. This is just a limited time for them to maybe pump up those numbers a little bit until things start getting better on McDonald's. But in total, in terms of net sales, they did grow 5%. And if you don't know the history of McDonald's, 5% might sound very low. But 5% is actually not too bad in terms of sales growth for McDonald's. A lot of people don't know this, and I talked about it in my last video. McDonald's has been declining in revenues from 2013 all the way to 2020. Revenues went from $28 billion to $19.2 billion. It has been declining every single year. This is due to a lot of things. It's due to a business maturing, but it's also due to them switching to more of a franchise business model, which is going to decrease their revenues a little bit, but it's going to increase margins. In 2013, they had 80% franchise. Now it's 95%. So this is what happened with McDonald's. It's one of the reasons. But the second reason is it's just more of a mature business, and revenue has been declining from 2013 all the way to 2020. And a lot of people don't know this. So the 5% is not as bad as you believe. But because McDonald's has been having such an amazing year, after 2020, 2021 they grew, 2022 not too much, 2023 they grew, 2024 they expect to grow. But if you compare it to 2023, they grew 10%. So 5% might seem low. But over the last 10 years, if they can sustain the 5%, it's not as bad as you may believe. Now, we did look at the revenue growth, and we saw the revenue has been declining. But if you look at earnings per share actually increased. For revenues, McDonald's is not even making the same amount of revenues they made in 2013. They made $28 billion. Like now in 2024, they're going to make $26.5 billion. So they're not even back to the 2013 level. But if you look at earnings per share, it was $5.55 in 2013. Now it's at $12.12. Now, how did this happen? For many different reasons. The first one is an increase in margins. Because of more of the franchise business model, it has higher margins. So net income margins did increase. This was one contributor. But the second contributor to the massive difference between revenues and earnings per share growth is actually the company buying back a lot of stock. Now you may say, what are you talking about? This is a good thing whenever a company buys back stock. Of course, I 100% agree. But McDonald's does not have enough free cash flow to pay a dividend and buy back stock. So they had to use a lot of that to do so. And this is something a lot of companies do. Lowe's does it. Home Depot does it. I believe, many different companies do that stuff. AutoZone does it. O'Reilly's do it. So, it's sustainable until it's not. But it's not the best way to do it. Unless it's like a huge stock market crash or something crazy. But this is an example of in 2015. You look at the total free cash flow was $4.7 billion. As you could look at the numbers. Now, common dividend pays were $3.2 billion, and purchases is $6 billion. So this is around $9 billion or 9.2 billion that were spent this year, and free cash flow was only 4.7. So the rest came out of the debt. Another example is 2016. Again, a lot of companies do that stuff to pump up earnings per share metrics. You could look at the free cash flow was 4.2 billion, 3 billion went to dividends, and 11.1 billion went to share repurchases. And this is just not, it's not just in 2014 and 2015 and 2016. It's also been happening a little bit recently. And I can show you some example. It's been getting a little bit better, but it still has been happening. Same thing happened. I mean, they barely made it in 2023. They had 7.2 billion of free cash flow. They spent 4.5 on dividends and 3 billion on buybacks, so they missed it by 300 million. But most years, they actually, like for example, this is in 2022. They had 5.4 billion of free cash flow. In total, they spent pretty close to $8 billion on buybacks and dividends. And this is why, long-term debt has been increasing for the company. It went from 14 billion in 2013 to 37 billion. So if McDonald's wants to keep hitting those numbers, it wants to keep growing. If they can maintain a 5% revenue, it's fine. And the free cash flow yield, I believe, is something I could look at it, something pretty close to 4.6%. So all I'm trying to say is that things look amazing for McDonald's because they've been using that to buy back stock. And that works amazingly well whenever you have lower interest rates. But if we have higher interest rates, it's going to put pressure on the company. If the company wants to keep borrowing money to buy back stock, it's not the best way to do it. It's been getting better. It got better in 2023. But I just want to highlight it because this is not the best thing for a company to do. And again, it works amazingly well in low interest rates. But for McDonald's, it's trading at a 4.6% free cash flow yield. Now, historically, the company or the stock has bottomed around 5.2, 5.3% free cash flow yield, as you can see on this line. Now it's sitting at 4.6%. So we're getting pretty close to this level. In terms of my valuation model on McDonald's, I agree with what the analysts have. The analysts have an average of a 9% CAGR from 2023 to 2028. And I think this is a very fair estimate because the company has been growing 5% in revenues, in sales. If they can keep the 5% sales growth and they have the 4.6% free cash flow yield and they use it to do buybacks and dividends, in total, I would expect around 9% expansion in earnings per share or in total return. And I think this is fair. Now, if we use the 9% that the analysts have, EPS will expand from 11.94 to 18.58. If it expands to 18.58, this is very good for the company. And if we look at the historical price to earnings multiple, now it's trading at 20 times earnings, which is on the low end. The company traded as low as 16 times, but that was mainly in March 2020. The mean has been 25. But now everything is slow for McDonald's and is trading at 20 times earnings. Now, if we assume 5 years from now, things get back on track, a lot of the stuff that's happening in the Middle East and in Europe is not going to be happening 5 years from now. If things get back to normal, what they used to be, McDonald's will likely trade at 25 times earnings. So we're going to take this 1858 of the 9% CAGRs that we talked about. We take the 1858 and then, we time it by 25 times earnings, assuming a slight multiple expansion from 20.5 to 25 times. We time it by 25. This is $464 per share. Now the stock is trading at 253. We divide that by 253. We get pretty close to 83% on the upside. So if you're buying McDonald's today, I would expect 83% on the upside over the next 5 years. But if you want to get it double over the next 5 years, or a 15% CAGR, which is what I try to look for, you would have to buy McDonald's around $230 per share. And this is assuming very optimistic case scenario, assuming the 5% sales growth, which is a new thing for McDonald's, maybe they won't achieve it. But assuming 5%, assuming the 4.6% free cash flow yield, which is stable, and also assuming a multiple expansion. So this is maybe the best case scenario. McDonald's to me is a buy around $230 per share. Now, if you're a dividend investor and you want to safe dividend, you're a very long-term investor, I would be buying McDonald's here and dollar cost averaging down. But if you're more conservative, you want to not overpay, wait for the right price, I would say anything around $230, $235 would be a very good buying opportunity on McDonald's. And I might consider even buying some myself or selling put options. I share what I do in my own group. If you're interested in joining, this is the link. But thank you for watching the video. It wasn't financial advice, just my opinion on the stock. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.